Hello everybody and welcome to lesson 2 on the Academy of Financial Trading Foundation Trading Program. My name is Sean Fitzgerald and today I'm going to be taking you through leverage, margin and all the other jargon we need. Now, just before we get started, just to double check that everybody can hear me okay. So if everyone can just give me a yes into the chat box, let me know you can hear me, sound is coming through okay. Obviously, it wouldn't be great for me to just be waffling on if nobody's actually listening, as much as I do love the sound of my own voice. Okay, no, seems like everybody can hear me, so brilliant. So let's get started. Now, before we actually get into tonight's lesson, I want to talk about something new here with us and our sister company, the Shaw Academy. I know some of you have come through the Shaw Academy, but introducing SATS, which is the Shaw Academy Talent Solutions. This is basically a new branch that we're opening up that will let you customize your career path. It'll let you identify and fill skill gaps on your CV and you yourself in life. What it basically means is that we have a team in here of recruiters who are going to be working for you, the employee looking for the job, rather than out there all the other recruitment companies that work for the employers. So therefore the job, their loyalty is obviously with the employers because that's who's paying them. Whereas with us, our loyalty is going to lie with you. Now that is something we're going to be talking about down the line in another few lessons, but it's something I just wanted you to be introduced to and be mindful of, as some of the Shaw Academy lifetime members already know. But over here, the Academy of Financial Trading, I just wanted you to have a heads up about it as well. Now, as always, before every lesson, we do have to go through our risk warning. As I'm sure you're all well aware, because you wouldn't be here if you didn't have some idea about what trading actually is, there is some risk involved. But obviously our plan here is to mitigate that risk as much as possible. But even with mitigating as much risk as possible, it does leave some there. So we do have to give this risk warning. Just make sure you're all aware of it, but I'm pretty sure you're all smart enough to have known this already. Okay, so some core concepts which we plan to build on. Previously in lesson 1, you had a broad market overview. We already covered that the financial markets are like basically a meeting point of buyers and sellers who agree by consensus the current prices that exist in the market. Now what we're going to have to do is look at the most important terms and fully understand them. This will help us analyze the markets correctly in order to find opportunities as discussed later in the webinar series. It's basically like going in anywhere. You need to know the language. You need to know the terms that people are using so that you don't miss opportunities just because you don't know some of the words. Now what I would say to you is, first of all, don't panic. Some of these words and explanations sound far more complicated than they actually are. I'll explain them. For some of you, it'll click immediately. For some of you, it might take an explanation or two. But don't worry, even if you don't get it immediately tonight, it will come to you. We're going to be using constant examples as we go through the lessons. People will be talking to you here. Your program support managers will be in contact. So don't worry if it doesn't click with you straight away. It will come eventually. And when it does click, it's going to be very simple and you won't forget it. We're going to focus on price action based trading. We're going to find all of our opportunities based on that. So let's build upon that now. So one of the things that we first hear in terms are the asset classes. So here's a quick recap of the main asset classes that we mentioned that are tradable and covered in this webinar series. You can trade commodities. Now commodities, what is that? Can anybody give me an example of a commodity? When I say to you, I'm trading commodities, what do you think I'm trading? Okay, brilliant. Everyone straight away knows the big one. Oil is the big one. Oil, natural gas, things, the energies, things like that. Now, I can see a few people talking about metals and stuff as well. Exactly. Gold, silver, platinum, copper. Daniel, thank you very much. Agricultural produce. Agricultural produce is what we would call a soft commodity. How we kind of usually remember soft commodities is anything that comes out of the ground, from agriculture. So coffee, corn, wheat, soybeans, cotton, I can see there, soft grown, Don, exactly, saying it like that. soft commodities, essentially anything you can pull out of the ground, and these can be quite volatile. Now, obviously, when you talk about trading, that's not usually where people go in their head straight away. Where people usually go is stocks or equities or indices. Examples, I'm sure we all are very, very aware of the big ones. Apple, Facebook, Microsoft, Google on the NASDAQ exchange. I'm pretty sure some of you are even using their products right now. It's just basically any company that you can buy stock in, anybody who's publicly traded. Coca-Cola, Kellogg Company, Bank of America, Ford, they're all on the New York Stock Exchange. On the London Stock Exchange, then you'd have, the big British companies obviously being in London, BP, Barclays. And then we have the German Stock Exchange, the DAX, where you would have companies like BMW. Now, the other thing you can do is trade composites of these shares. And this is what we say when we're talking about indices. This is where, like the NASDAQ, which is a composite of the top 100 US technology shares, or the S&P 500, which is the top 500 US companies, or the Dow Jones, which is an industrial average, some of the top 30 companies in the US. Now, it used to be just industrial average, but now you have companies like Disney, American Express, Visa in there, so it doesn't necessarily have to be an industry company. Now, the other thing you can do is trade derivatives based on government bonds, which are basically IOUs by governments to pay you back your funds with some interest. Obviously, the higher the preserved risk, the higher the interest rate or yield you would get from this IOU given by the governments. For example, the interest rate on 10-year bonds in Greece is approximately 10%. Now, if you think you were to get a government bond off Germany, do you think the interest rate on the same amount of time would be lower or higher than the Greek interest rate? Okay, exactly. I think we all pretty much know exactly what's going on in Europe. Yeah, in Germany, it's at about 1.89%. A year ago, interest yield in Greece would have been about 9%. In June 2012, it was at 30%, versus Germany's last year at 1.5%, whereas in June 2012 it was 1.62%. So you can see there the stability of the country, the stability of the economy, the government has obviously a huge effect on the interest rate. And then last but not least, you can trade foreign currency exchange, otherwise known as Forex. Forex just obviously being, a short term for foreign currency exchange. It's more than a $4 trillion market, so it's absolutely huge. It is the largest financial market in the world, and unlike other financial markets, the foreign market has no physical location. New York Stock Exchange, obviously in New York, London in London, the DAX in Germany. This has no physical location. It's just constantly happening around all the time globally. So what does this mean? It means that from practically anywhere, you can trade for 25 hours a day for 5 days a week. Also, because of this constant cyclical up and down, it doesn't have to start and stop according to a timescale. It doesn't suffer from bull and bear cycles like you could see in other areas, such as gold recently with the S&P, or the whole decade from 2000 to 2010 where there was no profit made. It's an extremely liquid market, meaning that there are less gaps in the market, which is very important when trying to mitigate risks, as we'll discuss later. As you see on the news yourself, as you see when you're going on holidays, while you're on holidays, you won't see your currency hugely spike or hugely drop in the 1 or 2 weeks that you're away. Now, the next chart is gonna look a little bit scary to some people, but I don't want you to worry, okay? This is what we call a Japanese candlestick price chart. Okay, now there's a lot of information on this chart and there's a lot going on. This is what we're going to be using on this. Now, before getting into the terminology in detail, let's talk about the charts that we're going to be using on this course. Like I said, they're called Japanese candlestick charts, and they're called candles because each period interval you're looking at looks like a little candle. You can see all these little green and red candles with wicks on 1 or 2 ends. Just in real life, it's very important to consider time and money. A trading chart is all about time and money. So obviously we're reading this from left to right in terms of time and bottom to top in terms of money. So this chart is the Great British Pound US dollar chart, which obviously means how many US dollars can I get for £1 sterling. So the base currency on the left and the quote currency on the right. So the base is always £1 sterling, and then the quote is the fluctuation we're seeing. So what we're seeing is for £1, how many dollars are we going to get? And we can see as the chart moves from the left, at certain points it was at 1.46, 1.47, then it moved up a bit, and I hope your screen resolution is good enough that you can see the grey line just across the top, and it points at the right hand side to 1.56. That just means that is the price it's at right now. And when I say right now, obviously I mean when this screenshot was taken. So you can see that since early July that the mark has been falling a little bit. This may not be so nice if you're planning to visit the States before Christmas, but obviously if you're coming the other way, it's a little bit better for you. Okay, so I hope you're all just kind of understand the basics of the graph. Okay, so it's just left to right in time, up and down in terms of money, and I'm going to explain the candles now. But before that, I just want you to have a look at the chart. You can see quite clearly that in July, it was $1.67 per pound, or that today it's only 1.58. Okay, so does that make sense to everyone? I assume we all understand just, a chart. Ignoring the candles for right now, we all understand time left to right. We all understand pound value up and down on the left. Sorry, dollar value to £1. Obviously, the time value we choose depends on the chart we choose. Okay, making sense to everyone, fantastic. So let's explain these little candles we can see. Now, these little candles, why do we use them? Is because they're actually quite brilliant. These little things provide a huge amount of information very quickly and very easily. They're thought to have been developed in the 18th century by Munehisa Hama, a Japanese rice trader of financial instruments. They were introduced to the Western world by Steve Neeson in his book, Japanese Candlestick Charting Techniques. In Beyond Candlesticks, Neeson says they were likely developed in Japan in the late 1800s. And that's about as much information as we have about that. But the name stuck, so we're going to stick with it. It's a combination of a line chart and a bar chart in that each bar represents the range of price movement over a given time interval. Candlesticks are usually composed of the body, which is the solid part, which is green on the left and red on the right, and an upper and lower shadow or wick. The area between the open and close is called the body. Price action above and below the real body are called shadows or wick ends. Okay, so what does it mean? Now, firstly, before I go on, I want you to know the green and the red. It doesn't have to be those colors. When you choose your candlesticks, you choose the colors. So if you don't like green or red, if colorblind is an issue, if you just simply have a bit of taste and you want to match something differently, the colors don't matter and you pick the colors. I don't know if we have any students from China on this evening or if anybody has traveled to China, but as you're aware, in China, red wouldn't actually be seen as the negative or pessimistic color. It would be seen as the positive. Whereas in the UK and America, the West, green is seen as go and positive, red is seen as stop and negative. So that's just the example I'm going to use, but I want you to all to be aware you can change the color based on what you want. Also, each candlestick represents a body of time, and that is up to us to choose. So a candlestick can be over 1 day, it can be over a 5-minute period. But as I explain it right now, I'm just going to pretend it's 1 day. And in this example, I'm going to use euro to US dollars. Right, so let's start off with the green candlestick on the left. Okay, so the bottom of the bar or the body is the open point. So what we're going to say is that the euro USD over 1 day was at $100. All right, so that's where it opened at the start of the day. Then, throughout the day, as things went on, business was done, trading happened, it dropped a little bit. The value went down. So the lowest point it hit at any point in the day was $80. Okay, then still throughout the day there was lots of movement up and down, it was bouncing around the place and it hit a high. It went up very, very high at one point. It went to $200. But it didn't stay there for the day. At the end of the day, it came back down, and then there was its closing point at $180. Okay, now does that make sense to everyone? Is everyone seeing that the body is telling you the movement of its open and its close, and that the wicks are just, if it went beyond the open and close, that you see that. Now, you don't necessarily have to have a wick. If during the day, the highest it ever went up to was $180, and that's where it closed, you wouldn't have a wick at the top. The same way you wouldn't have a wick at the bottom. Now, the perceptive ones out there among you have already probably figured out how the red one works. Red one is simply what happens if the open and close are switched. So the next day, or I will say a week later, we came in and the market opened up at $200, and everybody was feeling positive and things were going well, and it went up in the afternoon to the high of $220. But then when everybody had gone for lunch and they had a little bit of a carb crash, they came back, people weren't concentrating, the value went down and it hit a low of $100. But people got a bit of sugar into their system, that carb crash disappeared and it started recovering, and at the end of the day, it closed at $120. So we can see how brilliant these charts are, how much they tell us in just this one little candlestick. It lets us know where it opened, where it closed, and did it go beyond that range during the time period we specify. Okay, is that clear to everybody? Everybody's still with me, or have I lost anyone with the candles? Fantastic, excellent. I love when I see all yeses. It means we're all on the same page, which means we're all doing well. Good, good. Right, so let's talk about it a little bit more. So, now, we should all understand a little bit more straight away, okay? So we all understand time left to right. We can see the bottom. It's from the 3rd of May till the 28th of June. And at the top left, we can see that it's Euro USD, comma, daily. So it's the value of how many US dollars I can get for €1, and each candle in this chart represents 1 day. So it holds for different time frames and different instruments. You can set it to 1 minute, you can set it to 5 minutes, a day, a month, and obviously this depends on different asset classes for currencies, commodities, indices, stocks. Whatever you're tracking or watching, it has a faster or slower movement rate, and it also depends on how quickly you want to react to trades and do things together. So you will set the time period. You will decide what these candles are doing. So we're looking at price action over time. It's basically what it's giving us. So we'll delve into this a lot more in detail throughout the trading program. So don't worry if this isn't clicking with you straight away and you're thinking, oh, fantastic, I am good to go after 3 slides. This Sean guy's amazing. Don't worry, we're going to be expanding on this constantly. We're going to be moving. And, I can see a couple of people going, where do we get these charts? Do we have to make them ourselves? Well, luckily, no, pen, papers, and markers are not required. No home assembly. It's absolutely free. You can access them. And in 2 weeks, we'll actually be having a webinar where we go through how to access these, how to pull them down, and how to actually use them in a trading account. Just a demo trading account. We'll be going through it. We'll be having a demo on the webinar, so don't worry, we'll be going through. But here we can see that this Euro USD chart above, it looks broadly similar to the Great British Pound USD chart we analysed a while ago. And that's the great thing about it. No matter what we're measuring, no matter what we're going against, be it gold, be it corn, be it currencies, the charts are always going to look the same. We don't really care what we're trading. It's nice that you can say, oh, I'm an oil trader, I'm a gold trader. Sounds a little bit fancier than I'm a corn trader, I'm a potato trader. But that's not what we care about. We're just here to do one thing, and that's make money. So we're just going to pick the chart that suits us the best to do that. And then the products just slot in there, and the products are just a little tool to make us our money. So we can see here how strong the dollar was back in June. And let's see if we're able to read this chart correctly. Can you please type into your chat box how many US dollars you were able to get for €1 in July? So give me an answer. In July, when we hit July, so you can see, well, I'm not actually going to give any hints. How much were we getting in July? Okay, exactly. Different people choosing to use the different amount of decimal points. Exactly, it's 1.10604 because we can see at the bottom the 28th of June, we can see the cutoff point for that. It's clear when it moved into the next month. There was a bit of a drop. We can see that it was a red candlesticks at the start of the day. It opened at about just below 1.11, and we can see at the end of the day it closed at 1.106. Now, can anybody tell me, was that the lowest it hit that day? Or exactly, no. We can tell straight away. Okay, fantastic. It's quite clear, people out there, you're understanding these candle wicks. We can see straight away how much information we're getting at it. So let's have a look at another one. So this one then, we're looking at top left. We're looking at, again, euro US dollar. Like I said before, it doesn't have to be the same one all the time. I'm sticking with euro US dollars so not to get too confusing and bounce around. But this is very, very different. Why is this very, very different from the last one? Can anybody tell? Exactly. Thank you, Dragomir. You're fastest typing. It's 5 minutes, right? So each one of these candles represents 5 minutes. So when we look at the bottom, it's 1st of July at the start. It's 1st of July at the end. So you can see the amount of movement made just between 2 o'clock in the afternoon and 20 past 6 in the evening. Right? So we can see that there's a lot of movement. There's a lot going on. Right. So now, next thing I'm going to move on to. So we all understand Japanese candlesticks. We all even showed a demonstration of how we understand them. So now we're going to move on to another term. We're going to talk about pips. Now, we all know pips, the word from fruit, apple. A pip is the smallest part of an apple. So the best way to describe it is that if you go into a shop and your local shopkeeper is selling a can of cola of price of, let's say, £1, if the shopkeeper wanted to increase the price of that can of cola, what is the lowest increment he could offer that can of cola at? Okay? Okay, exactly. He could increase it by 1p. That is the smallest fraction, tradable price, actual fraction, real thing that he could increase it by. And that's what we use in trading as well. But we just call it a pip. Because, you know, we're talking about so many different things. We're talking about euro, US dollar, Great British pound, Japanese yen, you know, so many currencies, so many values. We don't want to constantly be using so many different terms. So what we're going to just say for everything is a pip. So a pip is the smallest tradable price movement a market or an instrument can make. So exactly, he can increase it by 1p. So it stands for percentage in point. So it is very important that you know what the smallest incremental move is, as this is what you're going to look at when you're trading. This is how you're going to decide how much you want to trade, how much you want to risk on each individual trade based on how many ticks or pip the market typically moves. Right, so let's look at an example here, okay? If you're trading euro US dollars, and I'm just using the same example again, it could be anything, remember, but we're just using this because it's simple. And we're going to say that it moves 1.320, that is 1 pip. So in the euro USD, 1 pip is 0.0001. So what is this? This is 1/100th of 1%. Now, the decimal place may change depending on the market. What I will say to you is in general, when it comes to currencies, it's going to be 4 decimal places. That's going to be your pip. Now, when I say in general, I mean in the vast majority. Now, in the example here on the right, I'm sure a couple of you keen-eyed folks have already spotted, well, Sean, how come a lot of these, like Euro Australian dollar, Euro USD, there's actually 5 or 6 decimal points? That's just to give you more information. The pip is still actually the 4th decimal place. If the 5th or 6th decimal place changes, that's not actually affecting the trade value at all in any way. It's just giving you a little bit more information in which way it's going. Now, there are some currencies where they will go beyond the 4th decimal place, but I don't want you to worry about that too much right now. Remember, tonight's lesson, we're just getting used to the terminology and the speak. So what's important to remember when dealing with currencies, 4 decimal places. When dealing with pips, it's the smallest movement I can make on my trade. All right, so is that pretty solid with everyone? We can all understand what I'm going to be talking about if I say pip as I go on? Fantastic, excellent. I'll be honest, I'm loving that everyone's keeping up so easily, not having to explain too many things. Good, excellent. So let's get into our next term, buying, which, is, I'm pretty sure you're all already familiar with what buying is. It's a reminder that when you're speculating on an increase in value of the instrument between now and some future point in time, you're going to put in a buy. What is the other term for putting in a buy? Can anybody tell me what is the term for putting it? Exactly. Richard, you got it spot on. Thank you very much. Brandon, you're right as well. Jacob, spot on. It's going long. When you say you're going to buy, you're going to go long. I'm going long on gold. I'm going long on the euro US dollar. It means I think it's going to increase. So, it's just buying, thinking you're going to have an increase. It's called going long. There are all these terms that sound a little bit different to what normal people would say, but once you know them, it makes no difference. It's just a term. So if you think that the market is more likely to rise than fall in the future, you're going to go long in something. It's quite straightforward. It's like buying an investment. You would not buy an investment if you thought it was going to fall. So, euro US dollars. If you buy in the euro US dollar market, obviously you believe that the euro will strengthen versus the US dollar. So you buy when 1 euro gets you $1.35. If the market went up to 1.400, so $1.40, you profit. Your $1 would then be worth $1.40. You bought it at 1.35. So how much are you profiting by? First, I'm going to ask you to tell me in pips. How many pips are we profiting by? All right, Barika, super fast, clearly mathematician. Raymond, pretty sharp on it as well. Okay, there's a couple of people getting the wrong answer. Remember, I'm asking you pips. How many pips are you profiting by? Majority getting it right. Those who aren't getting it, don't worry. It's 500 pips. All right, just remember, I said 4 decimal places. So from 1.4000 to 1.3500, that's 500 pips. So you bought at 135, you sold at 140, you actually made 500 pips. But how much did you make in real money? Okay, you made 5 cents, which is, not the most impressive trade in the world. I'm going to be the eternal optimist. I will always take a win as a win. 5 cents is still a win. I'm still up money. So, you got to look at the bright side sometimes. But if we're just going to be running around chasing 5 cent profits, we're not going to be the greatest traders in the world. You're not going to be walking onto Wall Street in a flashy suit with a bit of a strut on you, kicking in doors saying, hey, I've had 6 straight wins in the last week. Who's got the champagne? But let us continue with the assumption that you bought it at 135. And then the market fell to 130. Well, now we're not such a big shot anymore. This is why we don't get the champagne, because we've fallen by a certain amount of pips. How much of a loss do we have here? All right, good. Sarah, Joe, Raymond again. Oh, Raymond, your name is just popping up every time. Exactly, we're all pretty spot on this time, all right? The confusion seems to have disappeared. We're all now pretty much understanding these pips. It's 500. And what if we lost? Again, I like to be the optimist. Look, it is a loss, but it's only 5 cents. So we can handle it. No worries. It's a 5 cent loss, but we are down. We don't like to be down. That's not what we're aiming for. We're always going to be going up. Now, selling. Selling isn't necessarily where you're just selling something and hoping to make money off the profit. Just like the way you can buy in the market, you can sell in the market. And this is called short selling, or what's the other term for selling? If buying is going long, what's selling? Going short, exactly. And, there's the film in the cinema at the moment, The Big Short, is about speculating on a fall in value. It may seem like an alien topic to some people that haven't traded before. That's why I have the picture of the little confused bear. But essentially, if you're speculating that the price will fall. So with short selling, you're selling something without first acquiring it. All right, now some people do get a little bit confused on selling, right? You're selling or going short on the market. It's called short selling. You're agree to sell at the current price in the belief that the market would fall in value in the future. Now, what I will say first to you about selling, when we say selling and trading, we're not actually selling anything. We're just saying that it's going to fall in value. So selling is just a term for it's going to fall in value. Now, if some people get stuck here or get confused, don't worry. We're going to go through so many examples throughout the course that it will click with you. It will be fine. But I'm just going to give one simple example, just hopefully that it will click with you. If you don't get it, don't worry, we'll move on and it will come to you. All right? So I have two friends, Tom and Bob. And Tom has a Ford Mustang. And Tom wants to sell his Ford Mustang. And Tom wants to sell it for $20,000. And I go on the internet and I look up the value of a Ford Mustang. And the Ford Mustang is now valued at $20,000, but it's going to go up to $30,000. So I say, you know what, Tom? I am going to buy your Ford Mustang right now. And I go over to Bob and I say, Bob, I have a Ford Mustang, but they're worth $30,000. So you have to give me $30,000. Bob goes, thank you very much. Takes the Ford Mustang, and I've made $10,000 because I thought the value was going to go up. So I was buying the Ford Mustang and believing that the value would go up. Now, if Tom has the Ford Mustang and I believe that the value of Ford Mustangs are going to go down, but Ford Mustangs are currently valued at $20,000, like we said, but in a week they're all going to go down by $10,000. So I run up to Bob and I say to him right now, Bob, I'm going to sell you a Ford Mustang for $20,000. And he says yes. And then I come up to him in a week where the Ford Mustang is worth $10,000. I give Tom the $10,000 for the Ford Mustang. Bob gives me the $20,000. I've made a profit of $20,000 even though the value has gone down. Now, you don't need to understand exactly the example. You don't need to understand exactly the trade. What I just want you to remember is that when we're saying selling or going short, it's just saying that it's going to go down in value, right? We're speculating on something going down. So some other examples, right? Let's go back to our Euro USD dollar. If you believe that it would require less USD to buy $1 in the future, so you sell at 135. So it means we're coming in at the market at 135. So this is the amount you're going to sell €1 for. The market fell to 130. So we've actually made a profit even though the market has fallen. How much are we profiting by? Exactly. Thank you. I think you all have copy paste on 500 right now. I've made my examples a little bit too predictable. You've made your profit of 500 pips, or again, another 5 cents. So remember, we are speculating on price movement. In trading, we're never actually physically buying something, and we're never actually physically selling something. We're just going long, we're just going short, we're just buying, we're just selling. These are just terms. We're just speculating on price movement. And when it moves in the direction that we thought it was going to go, that's when we profit. And that's what's important to remember. So what if you sold Euro USD at 135? So we're going short at 135. We're selling at 135. During the day, the market rises to 140 and you closed. Well, even though the value has gone up, we've lost money. How much have we lost? Okay, you've all hit paste and enter because I'm just trying to save you all energy. You would have lost 5 cents or 500 pips. So it's just speculating on price movement. We're never physically buying, we're never physically selling. So what I just want you to all remember, if this is still confusing to you, don't worry, we're going to get through it. Just for now, remember, selling, going short, is believing that the price is going to go down. Okay, so is that clear with everyone? Are we all okay on selling being the price is going to go down? Okay, fantastic. Again, everybody still on the same page as me. We're doing very well. Excellent. Now, so we're going to move on to our next term, which is lots. Right. This one's very, very simple. In trading, a standard lot is a set trade size. Remember again that, we were talking about gold, oil, corn, euro, US dollar, the movement on it, we can't say how much movement there is. We can't say, oh, well, that moved this much, that moved that much. We're just going to use one term that everyone can understand, pips. It's the same way when we're trading something. I don't want to say to you, oh, I'm going to trade barrels of oil ounces of gold, kilos of potatoes, dollars of euros. We can't use all these terms. So we're just going to use a standard term for all products, for all commodities, for everything that we could trade, and it's just called a standard lot. In trading gold, a standard lot, 1.0 lot, is 100 ounces of gold. A mini lot then is just 10% of that, so 1/10. So, if we say something like gold, where one lot is quite expensive, well, we don't want to restrict everyone to have to trade at the minimum of a lot. So they can, if they want to, trade in mini lots, which is a smaller version of that. So obviously a mini lot, 1/10 of 100 ounces of gold, is 10 ounces. Then, of course, we can go one smaller again, which is a micro lot. Again, we're just using the decimal system here. Very simple, very obvious, which is 0.01 or 1%. And what's 1% of 100 ounces? I'm not even going to ask you to type it. It's 1 ounce, obviously, of gold. So, we've talked about the different asset classes: candlesticks, pipes, long leaves, shorts. This one is a little bit more simplistic and easy to remember. Now, to trade one lot, you simply enter the number 1 in the volume area within your MT4 platform. So you're now in effect trading 100 ounces of gold. Okay, so we can all see the volume term right here. Are we all looking right there? So if we say to it that we want to either sell or buy, either go long or go short on gold, if we do it by one lot, we're doing it on 100 ounces. So depending on the value of 100 ounces at the time, that's how much we have to put into the trade. If we have more money and we think, we're confident in our decision, we want to push a little bit further, obviously we'll put in more lots. If we have less money, if our budget's a little bit tighter, we want to be a little bit careful, that's when we go down. We go down just by moving the decimal point, and we'd go to 0.1 or 0.01. We'd use mini or micro lots. Right, so to trade one mini lot, you simply enter the 0.01. Again, very, very simple. It's basic maths. I'm pretty sure all of you are tracking it. Now, I can see a couple of people saying, what is the MT4 platform? Okay, so like I said earlier, don't worry. I think it's 2 weeks, in lesson 7, we're going to be going through a live example of a trading platform, and it will be this MT4 platform. And as you can see in front of you, it's quite simple, very easy to use. All I want you to look at right now is the volume area, and that down at the bottom there's a sell and a buy. That's all you need to know for right now, that this is a simple system where you put in volume, you hit a sell button, or you hit a buy button, depending on where you think it's going to go. That's all you need to know right now. When we get to the live example, I'll explain it far more in depth. And obviously, by the time you guys get to level 7, you're going to have a lot more knowledge to work with. A lot of these things are going to make way more sense. So just the third example, again, a micro lot is just simply putting in 0.01. We're going far lower. All right. So don't worry about the MT4 platform. That was just to describe lots. Now, leverage and margin. This is the point where most people get stuck. This is where a lot of people are going to get confused. It's a little bit hard to track, but it's also the bones of what makes trading viable for us. So I don't want you to get too hung up or worried. Like I've done before, we're going to go through it. We're going to discuss it. We're going to have working examples. But don't worry too much. Don't let it hang you up too much. So up to now, we've focused on the trade size and pip size, and how. Now what we're going to do is talk about what you need to deposit with your broker in order to make these trades. This is to be treated completely separately from those in your calculations. So we said earlier that the lower incremental move in the market for euro US dollars is 0.0001 euro, or for each pip movement is 1/1000th of a euro, or 1/100th of a euro cent, which is a tiny amount of money. We looked earlier, if a 500 pip trade happens, we're making 5 cents. So if we wanted to speculate on $1 per pip, we would need to trade with about $10,000 just to see some, real profits. In simple terms, you'd have to give $10,000 to your broker just to have a trade. So this is obviously out of reach for most people, and especially if you're trading with many markets, so you can be a diversified trader. And it's worth tying up such large amounts of money for such small returns? Obviously not. So however, as traders, we trade these exceptionally small increments of measurements with quite large amounts of money with what's called leverage and margin. Both are intertwined, they're flip sides of the same coin. All right. So instead of having to deposit 10,000 with your broker, what if they said to you, don't give us 10,000, give us $500 or even $100, or some brokers will even say to you $100. Give me $100 and you can trade. And you're thinking, well, how can I trade? I don't want to be making 0.001 of a cent on, after a couple of hours work. Well, a broker might offer you leverage of something like 50. He'll give you a leverage value of 50, so 1 to 50. This means that they will allow you to access the market as 1/50th of the actual price. So allow you to have an access. Obviously, they require a deposit. You need to put some money in. They're not going to let you do it for free. And this deposit is known as a margin. The margin is typically a percentage figure. So if the margin required is 2% of the trade value, as it is in this instance, it would be 1 to 50, or 0.02 or 2%. Right? So you can say what the value is. If they say margin is 2%, then the leverage you're getting is 1 to 50 or 50 to 1, depending on how you want to say it. Okay, so to trade one lot of gold, a price per ounce of 100 ounces, so gold could be at, let's say, $1,100 per ounce. Now, obviously, different amounts of money are different values to some people, but I can tell you, to me, $110,000 is quite a bit of money and not something I can just stick in on one lot of gold. So that is just the amount of money required to trade just this market, just one lot. And since the rates of change are so small, if gold goes up by a few or $4 or $5, I've gambled $110,000 to get $4. That's how much I've put on my trade. So since the rates change are so small, only by trading large amounts could you justify the effort. So for one lot trade in gold, if the broker would offer you a leverage of 1 to 50, that means your outlay would not be $110,000. It would be 2% of $110,000. And now the mathematicians, it's getting a little bit more difficult. I'm not going to just give you 500 pips. How much would it require for me to now trade? Exactly. We're down to a much smaller figure of 2,200. Pinico, I believe you were the first one in with the number, but Sven, Ross, Tony, Azar, all in very quickly as well. Jade, Lisa, very fast on it. But I can see that most people are getting the number pretty quickly straight away. So we're understanding this. Good. Now, why are we trading with leverage? Well, to answer why are we trading with leverage, let's continue talking about trading without leverage. So if you were to buy $5,000 worth of gold at $1,100 an ounce, how many ounces will that get you? Okay, again, math's getting a little bit harder. I'm making the figures. All right, some people rounding it up. Yeah, rounding it is fine. It's about 4.5 ounces. Here's the full-on calculation. But yeah, about 4.5. So now imagine gold rose to $1,150 per ounce. How much did you make? Okay, it was $1,100. Now it's gone up to $1,150. How much did you make? So we do the maths quite simply. It's 1,150. We have roughly 4.54 ounces, which will give us a return of $5,227.27. So obviously we take one away from the other, and that gives us profit of $227. Now, not a shabby amount of money, $227. You can do plenty with that and buy you a nice weekend. Just means you have to fly Ryanair. But what if we don't want to fly Ryanair? Because God knows nobody wants to fly Ryanair. We want to have first class flights to Barbados. So we need to be looking at something else. How are we going to do that? It's going to be with some leverage. So let's say we used leverage to gain access to gold at a rate of 1 to 50. So we can trade 100 ounces with a deposit of 2,200. So again, 1,100 per ounce by 100 ounces gets us $110,000 worth of gold. Now gold rises to $1,150 an ounce. How much did you make? Okay. Again, just rough figures here. I'm not expecting you to do all these maths perfectly in your head, but it's 1,150 by 100 ounces, which is $115,000, which gives us $5,000 in profit. Now, that's going to get you a much nicer plane seat than the original $200, and that's why we like to trade with leverage. So, leverage allows the trader to have a greater buying and selling power. Why do we want this? Well, because of the cost. Unleveraged costs per transaction are usually quite prohibitive, unless you can trade off a very, very large account. So, without leverage, most traders would only be able to trade very, very, very small amounts, and trading at these levels, it just wouldn't be justifiable. By the amount of time you're putting in, by the tiny amounts of profits you've made, it amplifies your gains. Now, on the other hand, it also amplifies your losses. Most importantly, without leverage, most individual traders typically would not be able to have a diversified portfolio, hence impacting adversely upon their ability to reduce risk. And if there's one thing we're all about here, it's all about reducing risk. And I can see people are saying, well, why would you want this? And why does this happen? Well, the cost of trading per transaction being quite prohibitive. If any of you have traded shares with a high street wealth manager, you would know this unless you're trading off a very large account. It's just not suitable for most. And with your trade size, you're only going to be making very small amounts, so it's just not worth it. So this leverage is offered to make it worth it. Also, we don't want to put all of our eggs in one basket, and so we want to diversify. And without leverage, again, we couldn't diversify. So with the advent of internet retail trading, you or me trading from home or the office or even on the go with your phones, you can do that now. We're able to put our money to work. We can make lots of money using smaller amounts of money. Now, obviously when we're dealing with smaller amounts of money making us larger amounts of money, there are going to be some safety measures put in place. So with the risk I've mentioned previously, this brings us onto the topic of used margin or a margin call. Used margin is simply the combined amount of margin required to keep all your trades open. So it's simply the amount of money that must be available, required by the broker for all your trades to keep going, for him to keep doing business with you. It's the amount of money you have tied up with your broker to maintain your trades. Okay? If your open positions were losing to such an extent that it endangers your ability to maintain enough capital with your broker and honor your trades, you would have historically received a phone call from your broker asking for more money, saying, I need you to cover all of these potential losses if things are going badly. They would say, you don't have enough money in your account, can you please deposit more money? Now, if your broker rang you and said, hey Sean, everything's going absolutely terrible. Those investments you made, no, going badly. I need you to give me way, way, way more money. How likely are you going to be to run down to the bank and say, broker called me, everything's going terrible, he wants more money, I better give it to him? Is that something you would be rushing to do? Well, Jacob said straight away, I wouldn't. Jade, a little bit more, I'm saying not likely. That's fair enough. But yeah, vast majority, no, we ain't going money. And Connor has described it in language that unfortunately I can't use on the webinar, but the broker isn't getting any of our money. So, train moving against you, put more money into that train, definitely not a good idea. So you never want to get into a position, and we never would get into a position like this, and traders using our methodologies should never have this situation happen to them. So in online trading, they don't call you up anymore. They just shut down your trades. You get an email, but the email will come way after the trades have all been shut down. And this is what's called a margin call. So it's where total open losses become so great so that they suddenly become equal or above a certain threshold, usually 90% of the required deposit placed with the broker to keep the open. So what the broker does is he just automatically closes all positions, which would result in you losing 90% of your money at least. Okay, now it should never be allowed to occur with professional risk management and the right training, but obviously we have to be aware of it. We need to know how these things work. Okay, now does the margin call make sense to everyone? Okay, it's the reason I go through it so quickly is because I really don't believe any of you, once you've gotten through this course, are going to be facing it, because it just shouldn't happen. But like we all know, there is risk. These things can happen, so we need to know what happens when it goes that direction. So yes, margin call. Just for the few people, the vast majority saying yes, but I did see a few no's. So a margin call, it's basically when your account is running out of money. And you're running out of so much money that your broker just shuts everything down. That's a margin call. So a margin call is all if your trades are stopped because the open losses have become are at a amount that is 90% or above, well, at least 90%, so 90% above the required deposit placed in the account with your broker. So it's just your broker saying, you know what, you've lost over 90% of your money on losses, so I'm shutting everything down to stop you losing more. Okay, so it makes a little bit more sense when I say it like that. It's just your broker stopping the loss of money because the money you have in the account isn't enough to cover all of the losses. So when you get to the 90% mark, he stops it. Okay, so now let's talk about spread or trading transaction costs. So in the perfect world, trading would be free. Brokers, but they have to make money as well. They're doing work for us. They're giving us a leverage. They have to make money, and they make money from spread. So let's again work with our little gold example. So we want to trade 100 ounces of gold at $1,100. Market moves up to $1,150. So this $50 move has led to a profit of $5,000. So what are the transaction costs? Well, how most traders do it is that they will charge you a number of pips transaction cost per trade. Okay, we all remember what pips are? I know we've gone through a few terms, but I hope the memory serves you all well. All fresh minds still got the term. Okay, we all do remember pips. Fantastic. So your broker will charge you a number of pips per trade, otherwise known as the spread. So just remember that the spread is just the number of pips per trade they are going to take as, their payment. That's what they're charging you. You then multiply it by your trade size to get the cost of the trade. So let's say, for instance, the broker will charge you 50 pips. So it will be a 50-cent charge per trade times the size of the trade. So how many ounces did we buy? We bought 100 lots, 100 ounces, by 50 pips, and the pips, and there we go, $5, because it was 50 cents, and then by 100 is $50. Does that make sense to everyone? The fact that I can see $50 written on the screen before I even asked, is everybody clear with that? Makes me think that it was quite simple. I can see a few people are lost. Pinnakin, no problem, don't worry. I'll go through it one more time. If you don't get it, don't worry, because we're going to talk about it. So what it simply is, the spread, is the cost of doing business with the broker. And how they do that cost. Obviously the broker has to make money, so they have to take their part. And how they're taking it is by taking a certain amount of pips. In this case, the broker is charging you 50 pips. So the market has moved from 1,100 to 1,150. It's led to a profit of $5,000. The broker will charge you 50 pips, so it's a 50-cent charge per trade times the size of the trade. How many lots do we buy? Well, we bought 100 ounces of gold, so it's 0.50 multiplied by 100, which is 50. So it's a $50 cost that the broker takes. All right, has that cleared it up? Okay, some people saying, yeah, it's just a trade fee, brokerage cost. There are some other terms for it. Yes, a trade fee, a brokerage cost. Yes, there are other ways to say it. It's usually referred to as the spread, and obviously I want you all to know what this term means when you hear it. So in conclusion, overcoming potential barriers, you want to make the spread a small percentage of your profit target. This is how you're going to make money. So let us imagine your average profit return was 100 pips. Your spread is going to be 50 pips. Well, is that a good thing or a bad thing, right? Our spread is 50 pips and our average profit return is 100 pips. Is that good or bad? Exactly. It's a bad thing because the cost of business is 50% of your profit target. That is a huge chunk of your profit to be paying. So obviously, no, we don't want to be giving half of the money we make to our broker. Now, your broker may be your friend and you're doing business together and you're trying to make money, but you don't want to be giving him half your money. But now imagine that your average profit return is 1,000 pips, but the broker is still just charging you 50 pips. Are we in an okay position now? Are we going to take that deal? Is this the way we want to do business? Yes, we do. Because what percentage is that? And I can see that John and Amy have already typed that, and so has Andrea. Exactly. Because it's only 5% of your profit target. And 5% is an okay fee. That's fair enough. So to overcome spread as a barrier to trading, we want much higher profit targets over longer periods of time. And I also want you to keep in mind that the daily average pip movements of the markets you trade, they're going to be very relevant to you. So that's why we want to think about them. All right, and that's going to bring us on to our next term, which is stop loss. Now, stop loss, it's again something that I believe you need to know. In an ideal world, all of your trades would be profitable, and but that isn't the reality. We're trying to mitigate risk, not make it disappear. But you have to be able to manage your losers as well. Remember, managing your losses well is just as important as managing your gains. If you manage your losses as well as you manage your gains, you will be a very successful trader. There's going to be losses. It's inevitable. So we want to have a protective line. We want to have a defense against these losses. One of these defenses is called a stop loss. So it's usually it would be called your first line of defense. So it's the price to exit at a loss if the market is failing to perform. So just because you don't want to lose doesn't mean it won't happen. So we do need these protections. No fighter pilot wants to get shot down. But do you think any fighter pilot will get into a plane without a working ejector seat? No, of course not. Because he knows that it's a possibility and he wants a way out if it does come to that. Stop loss is our ejector seat. It's our way out if it comes to it. We don't want it to happen, but it could, so we're just going to be ready for it. So good traders prepare for failure by capping losses. So when losses occur, even with multiple trades at the same time, the trader already knows how bad both one individually and all effectively could total. So, stop loss example. We're going to talk again about the Euro SD. All right? So at 1.32, we're buying. Okay? So what does buying mean? Where do we think the euro is going when we're buying? We're buying Euro USD at 1.32. Exactly. We all think it's going up. So we decide to put a stop loss at 131 because we don't think it's going down. We're putting a stop loss at 131. So we put down a trade size of $10,000. 0.10 of one lot. Right? So our exposure is 100 pips because it's the 0.10. Right? So what is the risk in monetary sense? Okay, I know there's a lot of numbers and a lot of zeros up there, but I would just take your time. I'm not going to rush this one. Have a look at it, okay? Your trade size is $10,000, which is 0.10 of one lot. Your exposure is 0.0100, which is 100 pips because it's 4 decimal places. So what is the risk to us in monetary senses? Okay, now I can see some people aren't getting it. A lot of people are getting it. If you're not getting it, don't worry. Like I said, we're going to go through lots of examples. We're going to be working it. But yes, for anybody writing it, it is $100. So if you have the $100, you were spot on. You're getting it. Agila and a few others, Daryl, don't worry. We're going to be going through lots of examples. We're going to be explaining it. Okay? We're going to be going through it, right? There's no one stop loss strategy that will fit all trading techniques, right? We always place stop loss on trades at prudent levels based on our specific styles and our techniques at the market. So without a stop loss, it's a bit like let your losers run and only close your winners. Obviously, that would be a terrible idea. So that's what got us into trouble, and that's why we're in the banking crisis. It's a bit like knowing how much money you have in your pocket when you go shopping. How much you're willing to spend depends on how much you decide in advance. So remember, no one can stop loss strategy fits all trades. You need to have a predefined, tried and tested, diversified trading methodology defined in advance to determine your stop loss levels. Now, I'm not going to go through that right now because we don't need to get that advanced right now. And that's why I'm not going to go through with too many mathematical examples right now, because you don't need to get to that level right now. You just need to know what a stop loss is. One huge and key likely component of this course, of course, is the risk management. So we're going to spend a full hour going through this as we progress further, particularly in lesson 9. It's just going to be all risk management. So for those who've been trading unsuccessfully, make sure you attend that class specifically. But to trade without stop loss is to ignore the potential for downside. And if you're ignoring the potential for downside, you're increasing the potential for harm. That is not good risk management. And like I've said before, and I'm going to say 1,000 times again as we go through this course, risk management is what we're all about here. Risk management is how we make money. So to predefine your stop loss is very much like being aware of cash flow with one's own business or financial affairs. Your exact stop location will vary per trade, and we're going to be talking about that when we're talking about trading strategy. There's no one place to put stops that works perfectly. You're going to have to tinker. We're going to be looking at lots of different examples. It's totally dependent on your knowledge of the current market. It's dependent on what the market is, how volatile it is, how much it jumps, how much you can afford to lose, how much you want to see it going up. But the one thing you cannot be is ignorant. Okay? So that's why we're going to train you we're going to teach you all of these things. Now, there is obviously an opposite to that. There is a limit order. So it's just working from the other direction. Just like a stop loss with a limit order, you're predefining where you're bailing out. But you're doing it from a more positive point of view. It's not for a loss this time, it's for a profit. So it's when you put on your trade, you're putting a predefined exit market if it moves to a certain point, right? So like a stop loss order is a predefined exit of one's trade when particular price is reached for profit. Example is when you buy a 0.1 lot of Euro USD at 1.32, you expect it to go up, you put a limit at 133, so it's a difference of 100 pips, it's a gain of $100, and then you just automatically get out. Okay? Does that make sense to everyone? I know we're just run a minute or two over time, but we're just coming up to the end now. So don't worry, we're almost closed. One criticism of limit orders is obviously limiting one's profits. You don't really want to limit your profits. Literally, financial loss is completely valued. If things are going down, you want to stop them going down. But if things are going up, do you really want to stop them going up? If you insist on intraday trading, and if you are targeting fixed pipe returns, then obviously they may be useful to you. Pip returns, sorry. But all brokers guarantee limits, which helps them limit your gains. So, the summary of the words we went through. Japanese candlestick. The way to look at price over time in a bar chart. Pip, smallest change possible in an instrument. So the smallest possible amount it can go up or down in a trade. Pip value, which is the monetary value attached to each increment of change that the pip has. This is obviously based on the size of the trade and on what's going on and what you're trading. Buying, speculating on price going up. Remember, it's not actually buying, it's speculating on price going up. Selling or shorting is speculating on a decrease in price over time. Remember that buying can also be said going long, selling is shorting. They're both just speculating on either up or down. Lots is a standard contract size, amount of whatever we're trading. The trade size is just that, the amount traded. Leverage is where they increase your trading power by a certain amount, a multiplier of your deposit. So if your leverage is 1 to 50, then you're getting 50 times the amount of the value for your trade for your deposit. Margin is how much you have to put down, your deposit. How much is the minimum to go into your account. Used margin then is the total required on deposit for all open trades. So margin is your money and used margin is your money being used. Spread is the cost of trading charged by a broker, usually by a certain amount of pips. And then stop loss is our ejector seat for losses, and limit order is our ejected seats for wins. But again, as an ejector seat isn't fantastic in a jet when you're winning, it's not the greatest thing in trading either when you're winning, but it is there for certain situations. Maybe you're in rush for dinner and there's no landing strip around and the jet is just going too quickly, so you need to get down to the ground quickly. There are some times you are going to use it. It might not just be the best idea. So we're going to examine a chart and make a quick decision before the Q&A, and this will be the final part of the lecture. So in trading, you have to make decisions. So we're going to repeat this exercise at the end of each lesson, and obviously what I'm going to do is through the lessons, as we go through them, some examples are going to get harder, but we're going to start off with quite a simple one. So it's a weighted index of the top 500 companies in the US. Had an unbelievable bull rise since March 2009 when it was below 700 to tipping over 1700, currently hovering at about 1750. So it's hitting all-time highs in this current climate of low interest and money being pumped into the US economy by the government. On the 18th of December, the US did taper its 85 billion monthly asset buying program by 10 billion, but 6.5% is the target unemployment rate, now 7%. Now, all these figures, don't worry. I'm just giving you an explanation. You don't need to remember them all. An inflation target is 2% monthly long-term objective, currently running at 1.2% from November figures, according to the Bureau of Labor Statistics, which will come out again this Friday. So we can see that in general it is rising. But we can also see that there's a bit of a cap at the top. Whenever it hits this cap, it seems to bounce back down. It just doesn't seem to be able to break through the 2131.60. Just does not, every time it comes up to it, each point, it just bounces back down. So, are you going to go long or buy? Or are you going to go short and sell? Or are you going to do something else? Okay, now we saw this general increase, but at the end, we've seen that there's a breakthrough. It's falling through the bottom. It's behaving very, very erratically. Okay, I'm going to leave the lecture there. I'm going to leave the example there. I'm going to come back to it and we're going to discuss it. But what I'm going to do is I'm going to quickly get a drink of water, do our conclusion, and then we're going to do our Q&A. So this webinar has been more focused on bringing you to the application rather than the abstract. Just want you to get to know the words. We're going to become less theoretical now that our foundation is beginning to develop. So you may need to watch these recordings again to go through our member login area. What I want you to do next is watch out for your reminder of your next session. All training sessions are held live online each week at the same time with an extra session midweek like today. All videos are available throughout your site with your login, and they'll always be uploaded within 24 hours of the live version. And you can view the recordings as often as you see fit. Remember, they are there for your development, for your practice, okay? The next one is lesson 3, which is an on-demand lesson, which will be added to your student login area on Friday. This is on fundamental analysis, which is not going to be a huge part of the course. So if you don't get hugely into the fundamental analysis one, we kind of say that it is optional. Obviously, I would recommend that you do take the lesson, you watch the video, but it's not necessary to the course, okay? It's not going to be what we focus on. It's not something we're actually going to be using. So lesson 4 is when we're going to be getting back into what we use. But tonight's lesson was just to get you familiar, get you involved, and get you to realize what's going on. And what I would say to you is, if you need to watch it again, feel free to watch again, practice a bit. But don't worry if things don't click with you. Your program support managers are going to be in touch. We're going to explain all these things over and over. They will click with you again. Okay, like I said, I'm just going to take a quick drink of water. For anyone who needs to head off now, I'm sorry for going the 10 minutes over. We just got a little bit too into it. We were enjoying it. But I'm going to take a quick drink of water. Then I'm going to come back and do the Q&A for about 20 minutes. Anybody who needs to head off now, no problem. You can come back and watch the Q&A in the recording. For the rest of you, I'll talk to you in a few minutes. Okay, take care now. All right, everybody, I am back. So let's get into these questions and have a little bit of a discussion. James, I'm confused on the margin call. When you are talking about an open trade, does this assume that you are either buying or selling? Because if there's a big loss and you can choose not to sell because you believe it will go back up, or will they still do the margin call? James, it doesn't matter in which you're buying or selling because you're speculating on it going one way. So a margin call is when your speculation is wrong, when it's going the other direction. It doesn't necessarily have to be increasing or decreasing in value itself. It just has to be going against what you said, which means your money is disappearing. So even if the value is going down and you had gone long, but if the value of the Forex is going up, say for instance, but you had gone short, that means your account is drying up. And I can see you're saying, well, if you think it's going to go back up, will they still do the margin call? Well, your broker, you might tell your broker, I believe it's going to go back up. And the broker might say, well, I don't believe that. And you've run out of money. So that's why they do the margin call. So the margin call is when you're running out of money. And once it's past 90% of your funds are gone, that's when they pull in the margin call. So it doesn't necessarily mean on the value of the market itself. It's the value of your account going up or down. And it's based on you going long or going short. So what you thought was happening. Let me just have a look here. Do you have a recommended amount to trade on? I wouldn't say we're going to give you a recommended amount. My recommended amount would be no more than you can afford. Obviously, we don't want you gambling your life savings or anything like that, or doing anything silly. But what we will do as we go down the line, we'll be discussing amounts, and it really depends on the market. It really depends on what you want to get involved in. Do most brokers make money on both the commission spread and the bid-ask spread? Yes, Dylan, they charge the spread. So it's basically a transaction cost, and that is how they're making money. So yeah, that's usually where you'll see where the broker is making the money. In regards to marginal leverage, what is the cost of borrowing that money? Well, Garrett, that is the transaction cost. So whatever amount of pips they choose, and it's based on the spread. So it's the broker cost, the transaction cost. It's called the spread. Now, we're going to be looking into this way more in future lessons, so don't worry. If Forex is 24 hours traded, then how do we have open and close? Good question, Pinnigan, because you did notice, well, if it's open all the time, how come there's an open and close? Well, it still does close because it's for 5 days. It's 24 hours a day, not for 7 days a week. It's for 5 days a week. So there will still be an open and close at the end of each of that 5-day period. In the candlestick chart, the closing point of a current day should match the opening of next day. Why is it different for some days? Well, sometimes usually it should be like that, as you pointed out, yes, correctly. But sometimes they can gap, it's another term, as if some major announcement came out. But it is usually very, very rare. You are right, they should be starting and stopping at the same point, but it can happen in rare instances that there is a gap because of something strange happening. Is the spread per transaction either buying or selling? That's correct. Yeah, it goes either way. Examples of how margin works. Terence, we're going to be getting far more in-depth on margin. So right now, you don't need to know how it works. Tonight's lesson is just on knowing what it is, okay? So I want you to remember all of that, okay? Now, I did give examples of how things work and why they work and why you do them. But that doesn't necessarily mean you have to right now know how it works, and going forward, you're in trouble if you don't. That's not what this lesson was. This lesson was to get you familiar with these terms, get to know them, and then going forward, then when we discuss these in depth, when we get to the lesson about margin, you can say in your head, all right, okay, yeah, I remember we discussed margin. Oh yeah, leverage, I remember we discussed that. It's in my head. You've grown a little bit more comfortable for it. So then when we get there, you can actually understand what we're talking about and you'll be fine. Okay. Jeffrey, how can I access the previous webinar? I have a meeting in the And I don't know when you have the meeting, but I assume it's soon. So Jeffrey, if you go to the website, the Academy of Financial Trading website, so academyft.com, you'll see a little login in the top right, and you just click on that, log in with your username and password, and the list of recordings will be there. So recording 1 is already in there. Recording 2, obviously I haven't finished it yet, but it will be uploaded to your student area within 24 hours, so you'll see it then. Look me now. How do I ask questions? Joffrey, exactly by typing like that. Just work away. Dragomir, if the value is going to go down, does that mean you buy it at high? Or going short is by selling your already owned actions that you think will go down. Again, Dragomir, selling is confusing, right? So you're not selling anything you own, okay? You're not actually selling it, right? So don't get too stuck on the word selling. Just remember that selling means you're speculating on it going down, right? Don't call it selling if the word selling upsets you. Just call it going short. Or just say, I'm speculating on it going down. I'm going short on this. It's called selling. You're not actually, you're not buying 100 ounces of gold. They don't post them to your house and then you go on the internet and say, well, I have 100 ounces of gold. I think it's going to go up in value. Who wants to buy it? You're not physically buying or selling anything. It's, we're speculating on the price and we're going up and down on it. And selling is just we're speculating on it going down. All right. So don't get too hung up on that. If you buy on the Forex, do you have until market closes at the weekend? Or do you have to sell by then? No, you can hold a trade over the weekend. Here at the Academy, we on average hold trades for about 10 days. So you could actually go through 2 weekends. It really depends on when is the best time to move on the trade, to when is the best time to close it. It might not, there's no time limit set by, the market. You decide when is the best time to move, and that's when you do it. Can you only take the final exam once? Piers, it's usually just once, but, if there's some reason you need to take it again, if there's extenuating circumstances, if something happened, I would say don't worry. We're only on lesson 2. And don't be talking about failing the exam on lesson 2. You're going to do fine. You can take it more than once if you absolutely have to, and we will discuss that with you, and we will support you on it. So don't worry, there's no issues there. In the candle chart, does the green candle always reflect the price going up? Well, Bright, yes. In the charts I showed today, yes, because I chose green to show going up. But remember that the candle chart you're looking at, the colors might be different. Somebody could choose, blue is up and green is down. Or somebody could choose, yellow for up and black for down, or black and white. You can choose the colors. Now, in the examples today, yes, green was always up and red was always down. And when you set your candles for when you're doing it, you'll set one color that will always be going up, and you'll set another color for it always going down. Can we trade with micro lots in every market? Stephen, yes, you can. In theory, you can buy the market drop and you can stick with it until the market recovers. Yeah, of course you can, David. Yeah. But, if you buy and it's going down, you're in a losing position. And you cannot have a loss larger than the margin. So, there could be a margin call if it goes down too far. Now, it could go up again. It is possible, of course. But, that depends. We'll be getting more in depth into that. So don't focus too much on that right now. Just remember the terms from tonight. That's what we're going to take you through it one step at a time. So don't be getting ahead of yourself, confusing yourself, getting lost in other steps. Focus on these steps and you're going to be fine. Don't worry. Karina, when you say you close at X, does that mean that you continue the next day when market open, or that you exit sell? And when you say you close at X, that mean when you continue? Yes, yeah, you continue until X. You choose X and you continue until then. Be that through a day, a night, a weekend, a week. You keep going until your chosen X appears. Zarufi, I don't fully understand the Japanese candles. Zarufi, that will take me a while to go through again, and it works better when I have the diagram in front of me with the little arrows. So my advice would be go back, watch the recording again. you can skip forward to just a bit in the Japanese candles. Watch that 5 or 10 minute segment a couple of times. If you get stuck on it again, even after that, don't worry. Your program support manager will be in touch. They'll give you a call and they will happily go through that with you. All right, so don't worry. How can I test my strategies on previous data? Dave, you are jumping way ahead. Way ahead. We're on lesson 2. We're learning our terminologies and you already want to test your strategies. Don't worry. I love the enthusiasm. Definitely. Brilliant. Fantastic. But don't rush ahead of yourself. We're going to get there. Don't worry. Okay, what percentage of my capital should I risk per trade? Mark, again, you and Jordina, way ahead of yourselves, flying way ahead. Don't worry. We will discuss that, and we're going to get into it. We're going to get into that actually quite specifically. That is a big part of our strategy, is how much of your capital should you be risking. So we're going to get into that quite in depth, and but we'll be doing it later. So don't worry. Is there an exam at the end of the course? Yes, there is. For you to get your diploma at the end, there is an exam that you take. Okay. Do we get exams at the end of lessons? There will be a quiz uploaded in the student page this Friday. So yes, you will get some practice assessments. But then the final exam is the one that your diploma is based on. But there is some practice assessments that will be uploaded into your student area. So don't worry on them. Is the scheduled lesson for the same as the on-demand lesson? No, lesson 4 and lesson 3, one is live and one is recorded, but they are 2 different lessons, lesson 4 and lesson 3. Just because we do a recorded lesson 3 and then a live lesson 4, lesson 3 is a completely different topic. Lesson 3 is, on fundamental analysis, which, like I said, we are not going to be concentrating on too heavily during this course. But obviously, we upload it to your area on Friday just for you to know what it is. So when you hear about it in terms of trading. And Jackie, just answer your follow-up question there. When is lesson 3 uploaded? It will be this Friday. Yeah. Oh, yeah. Well, you saw it before I said it. Fair enough. Which brokerage platform is preferred? David, we're not going to discuss any of that now. Don't worry about any of those type of things, right? We're going to be looking at examples and stuff when we get down the line. We're not going to be looking at that type of thing until lesson 7 when we get more into the technicalities. Again, don't get ahead of yourself. Just focus on what we did tonight, what you got in lesson 1. Let us slowly build you up through 10 lessons. Don't run before you can walk. What can we do with our diploma? Well, the best thing, David, I'd say with the diploma is, number 1, hang it on your wall or in your office. Number 2, add it to your CV, because it is a very strong addition there. It shows a very good understanding of a very important topic. And also it'll give you, the ability to further your education and go on and become a trader down the line, should you want to build on that diploma. And if it's something that you decide, what, I am interested in this is something I am going to develop and go on to do. It's a great starting point. It's a launching platform. And from there you will move on. Do we get reminders once anything is posted Friday? Yes, Terence, emails will be sent out to you reminding you that the stuff is there, so don't worry. Do we get a diploma or a certificate? Abraham, it is a diploma. Will the Friday lesson be available online? Yes, it's added to your student area as a recording, so you should have no problem accessing this. Okay, guys, I do have to wrap it up there now, just to let all the program support managers answering the questions in the tech boxes go home. I can't keep them here all night as much as I'd love to just stay here and chat. I hope you all enjoyed the lesson. Thank you all very much for your attention. Remember, next lesson, fundamental analysis, will be added to the student area as a recording on Friday. I hope you all enjoyed the lesson. I take care now. Goodbye.